Hello, hear me? Hello,
It's picking up your other camera.
hear me? Hello, hear me? Are you able to hear me? Are you able to hear me, ladies and gentlemen? Please go to the chat room and mention yes if you're able to hear me. Go to the chat. Go to the chat room and mention yes. Are you able to hear Mwalimu? All right. Thank you so much. Thank you so much. And I hope you have shared this link with everybody in the SPR. Have you shared the link with everybody in the SPR group? People should not wait for me to share anything with them regarding Zoom. You're not sharing anything. Hello, Katunge is here now. Katunge will be able to take care of that. Ladies and gentlemen, here we are, and I would want us to move with speed, lots of speed today, because this is the last class. We should be able to do theory. So lots of speed required. Lots of speed required today. I can see we are 38 in number, which is very good. Very good. Then I should be able to come here and share my screen. Now, ladies and gentlemen, this is what I would want us to do today. This is what we are doing today. I've tackled most of these questions. Revised. Is this the one that is revised or final? I don't know. We have done most of these questions really. So then my work will be very simple. My work will be very simple. Basically, I'm coming here to tackle some like 3 questions. 3 questions, and then we shall be done. Yes, we shall start with this one here. May 2019, question number 1, A and B. May 2019, question number 1, A and B. This is AFRA. A significant number of entities and countries have adopted International Financial Reporting Standards, IFRS, as their basis for financial reporting. While the advantages of a common set of global reporting standards are recognized, there are a number of implementation challenges at the international and national levels. If the objective of an improved and harmonized reporting system is to be achieved, required, discuss 3 implementation challenges that are faced by International Accounting Standards Board in its push towards a successful move to IFRS. Ladies and gentlemen, then why is it that there are still some countries that are not able to adopt IFRS, that are still resisting IFRS, like the mighty United States of America? They haven't yet accepted IFRS. China, the whole of it, they haven't yet accepted the IFRS. So what are the main implementation challenges here? Number 1, you can see here we have diverse jurisdictional requirements. Different countries have unique legal, regulatory, and cultural contexts, which may pose challenges to widespread adoption of IFRS. So different countries are quite unique. They have different laws. So in this case here, there are those countries that would expect that, for example, their financial reports to be exactly mirroring their tax reports. All right. So bringing in this case here like IFRS, which is not agreeing with their tax laws, becomes quite a challenge. So diverse many jurisdictional requirements. Varying levels of accounting infrastructure. Some countries may lack the necessary accounting infrastructure, including qualified professionals, regulatory oversight, and institutional frameworks to support the adoption and implementation of IFRS. The IASB may need to provide technical assistance and capacity building initiatives to help countries develop their accounting infrastructure and enhance their readiness for IFRS adoption. We have the concept of what here translation and interpretation issues. IFRS are published in English, which may pose challenges for non-English speaking countries. Transitional challenges. Ladies and gentlemen, moving from one financial reporting framework to another financial reporting framework is a big Herculean task. Transitioning from local accounting standards to IFRS can be complex and resource intensive for reporting entities. Education and training needs. Adopting IFRS may require education and training for accounting professionals, regulators, auditors, and other stakeholders to ensure a comprehensive understanding of the standards and their application. Lack of what here? Knowledge. Enforcement and compliance. Ensuring consistent enforcement and compliance with IFRS across jurisdictions can be challenging due to differences in regulatory oversight, enforcement mechanisms, and legal systems. Now, ladies and gentlemen, please listen and listen to me very well. Whenever we are looking at these complications of IFRSs, why IFRSs cannot be adopted like globally. It's about 160 countries that have been able to accept IFRSs. Most countries do not want them. Like the French-speaking countries don't want them. Now, please listen and listen to me very well. Whenever you're looking at those challenges of implementing IFRSs, always look at number one, most of those countries do not have qualified accountants in terms of IFRSs. They are not having accountants who have done CPA, ACCA, for example. Then in this case here, they have their local standards knowledge. So then implementing IFRSs becomes what here? Quite a big task because of what your lack of professionals. That is why if you look at, for example, Rwanda. Like right now, Rwanda and even Ethiopia, they are now transitioning to IFRSs. It's normally a big project. Even World Bank now is funding resourcing there. It is funding training of accountants there. Then we have the concept of what here? Language barriers. Like now, when IFRSs were being introduced in Tanzania, most IFRS, or rather most accountants in Tanzania, do not know very good English. They're very good in Kiswahili. So there is quite a lot. So language barrier will always make guys resist this change. Then the resources required. I can tell you, we have been able to do like this IPSAS implementation for bodies like IGAD, Intergovernmental Authority on Development, which is a smaller version of AU. You need a lot of what here, a lot of resources for you to be able to implement. So to transition from one framework to another is a big problem. All right. There is even the aspect of infrastructure. It's not very many countries, for example, that have the SAPs. You need the software. All right. All right. We have the concept of different laws in different countries. So if, for example, Kenya law says this, the other country, in this case here, law says this. So then how will you be able to really provide that oversight? It will become very, very expensive. So I hope that is clear. I hope that is clear. And please, if there is anything that is unclear, you are free to always ask questions, there. Now, ladies and gentlemen, if you allow me, I'll be able to continue pretty fast and take back my paper up. International financial reporting standards are primarily designed for public limited companies. It has been argued that the same IFRSs should be used by all entities, or alternatively, a different body of standards should apply to small and medium-sized enterprises. Discuss any two reasons why there is need to develop a set of IFRSs specifically for SMEs. Actually, right now, this question should read, discuss any two reasons why we have a different, because now this is in place here. We already have this IFRS specifically for SMEs. So, ladies and gentlemen, remember SMEs, just like you have said up there, they don't have really capacity. Most of them do not have, in this case here, enough accountants. So then when you give them their set of IFRSs, you're really going to make things simple for them. All right. So in this case, they lack personnel. They also do not have enough resources, enough cash to implement what here full IFRSs. They don't have, in this case, infrastructure software, which will be able to punch all those numbers, in this case here, to give us reports which are full IFRS compliant. All right. So if you allow me, we shall be able to read these answers pretty fast here. So we are told here, simplification and cost reduction for them. Relevance and materiality. Many of the accounting requirements under full IFRS may not be relevant or material for SMEs due to their smaller size, simpler organizational structures, and less complex financial transactions. By developing a set of IFRS tailored to the unique needs and characteristics of SMEs, accounting standards can focus on specific reporting requirements that are most relevant and material. Then we have the concept of better decision making. You can imagine disturbing like SMEs to do accounting under what we call hedging reporting, hedging, H-E-D-G-I-N-G. I mean, that will be too much for them. They'll waste all their resources in tracking down events here. Would want things that are relevant and material applicable to SMEs. Then we have, of course, better decision making and access to finance. I mean, again, we have things that are just applicable to us, so we shall be able to make better decisions. It will be quite easy for us to pick better alternatives. Then we have here tailored disclosure requirements, global consistency and comparability, encouraging this I cannot forget, encouraging adoption and what year compliance. Just for example, like the e-teams that the government is really battling with to have all companies onboarded. You know, SMEs are really fearful because they know that they do not have resources, all right? Even the fear of the unknowns, lack of what year capacity in terms of accountants, all right? Once in this case you bring something smaller for them, then you'll be able to encourage what year adoption. So, ladies and gentlemen, it's important that we have these IFRSs for SMEs. Number one, because of reducing costs for them. Number two, enabling them to, catch up, adopt. They'll be able to see, like, this is quite something that we can be able to chew. All right. They will not be able to see a Goliath in front of them. All right. So, in this case here, that will really be able to reduce resistance to change. Then automatically SMEs have got like not fully qualified accountants. The resources are not really that much. So we need something smaller for them, a smaller version of a IFRS, which will be able to help them to catch up, to catch up, to catch up. We don't want complications. And are you able to remember, my good students, these exceptions? Are you able to remember like the standards which these SMEs are exempted from in terms of IFRS? Are you able to remember? Are you able to remember them? 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 Hi, Dabaso. Sorry, at times I may not be able to respond, but are you able to remember those particular exceptions of IFRSs? I'm repeating again. Like EPS. EPS, yes, they're exempted from EPS. Thank you, Nancy Jerop. What else? I can assist. They're exempted from, say, segmental reporting. Segmental reporting, I can assist. What else? What else are these guys exempted from? I would really love to hear from you guys. What else are they exempted from? What else are they exempted from? They're also exempted from hedging, isn't it? Hedging. They're exempted from anything to do with the interim reporting. When it comes to, for example, IS 16 PPE, whatever, okay, okay. Kindly use laptop screen, not main camera, interim reporting. Now, I think I will still continue sharing the way I'm sharing Alango because of time. Because of time, if I start making changes to these systems, I'm so sure I will be able to lose you out. After all, I'll be able to share this handout with you after the class, isn't it? But are you able to follow? 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 Somehow, are you able to follow? Please type there. I'm so sure YouTube typing on YouTube is a problem. All right. All right. All right. Thank you very much. Then, ladies and gentlemen, if you allow me, I will be able to share this back, and then we continue here. Thank you very much. So then come here. We have May 2018 question number 1. This is quite a common thing, very common in your exam. It's about sustainability reporting using a framework called GRI, Global Reporting Initiative. This one I must really go slow and even increase my bass tone because this is very important for you guys. GRI. GRI. Remember, we have sustainability reporting. Sustainability reporting, we have various frameworks. And one of those frameworks is known as what here? The Global Reporting Initiative, GRI. Has a mission to develop global sustainability reporting guidelines for voluntary use by organizations reporting on the 3 linked elements of sustainability, namely economic, environmental, and the social dimensions of their activities, products, and services. Required, describe 4 social indicators. Social indicators, ladies and gentlemen, in this case here are indicators about people, the stakeholders, social indicators that might be reported under the social what year dimension, that might be reported under the social dimension. So, ladies and gentlemen, under the social dimension, what are we required really to report? Very, very easy, really. You see, you look at your stakeholders, like employees. Of course, the social dimension, I mean, do we have some welfare programs for them? Welfare programs for them. I mean, the salaries we are paying them, they may not be really very good, but are they adequate to give them some good livelihood? All right. So in this case, here we are looking at, the payments here. Now, ladies and gentlemen, still in terms of employees, do you have good practices where, for example, you don't encourage like child labor at all, sexual exploitations at the workplace? Do you have a policy on that? All right. Or you don't want predators at the workplace. It's very wrong to have predators at the workplace. All right. All right. So when you talk of social indicators, like for example, how fast do you pay your suppliers? Are you that kind of an organization that when these suppliers are bringing in their materials, you are always so happy clapping? But when it comes to paying, they become what? They become enemies number 1. They become enemies number 1. Are you that type of an organization? Are you that type of an organization that these guys now will become enemies simply because you do not want to pay them? That is the time, in this case, ladies and gentlemen, you start feigning sickness, that the CEO is sick. Signatories cannot be found. So then we have the aspect of human rights. Remember that these are employees, these are suppliers, these are, the community around. So in this case, they have their own rights. So do you respect, in this case here, and of course, always promote human rights within the operations here? Very, very, very important. Do not discriminate. You know, when you are promoting human rights, you are not supposed to discriminate against people. Usikasema ati wewe ni rasta. Hapana. So long as ameingia kazi, usimvute kazi on the basis of, all of us cannot fit onto your lenses. We are not your children at the workplace. We've come here to work, and we must be very, very what here? Very, very tolerant. We must be very, very tolerant. Ladies and gentlemen, in terms, of course, of the social dimension, then we have issues to do with stakeholder engagement. Are you that kind of an enterprise that just makes decisions haphazardly? Or in this case here, the moment you have hit like an organization like Safaricom, you have become so big, would want to do something for the community. For example, establish a school there. You don't just wake up and start building a school. You must even ask these guys. So we have stakeholder engagement. Then, of course, the other category of people is what we call the customers. Are they satisfied? Customer satisfaction. All right. All right. Then, of course, you must, if it's people you're dealing with, ladies and gentlemen, you must always talk about what here ethics and what here integrity. Ethics and integrity. If it's people, are you training them? So allow me to share this pretty fast, ladies and gentlemen. Pretty fast, ladies and gentlemen. There are really many things you can talk about the social dimension. The social dimension. There are very many things. The things that I have about social dimension can spread from here to Timbuktu. All right. So, ladies and gentlemen, describe 4 social indicators that might be reported under the social dimension. We have labor practices and decent work. These indicators assess the company's employment practices, including aspects such as diversity and inclusion, equal opportunity, non-discrimination, fair wages, working hours, occupational health and safety, employee training and development, and compliance with labor laws and regulations. Then we have human rights. Human rights indicators evaluate the company's respect for and the promotion of human rights within its operations and supply chain. Like, for example, if you are working for a company that does not want you to join COTU, they are automatically infringing on human rights. Employees in this case here want a say, to have a say from other quarters. So it's important you allow them to join COTU. Community engagement and development, we've said in this case here, for people, remember social perspective is people perspective. You are dealing with the people, engage them. Whenever there are issues, open communication is very important. Then we have here customer satisfaction and relations. Customer related indicators assess the company's relationships with its customers and its efforts to meet their needs. Then we have supplier and business partner relations. I mean, you must be good. We have employees, well-being and engagement, ethics and integrity, access to education and training, ETs. Ladies and gentlemen, remember sustainability reporting? You're supposed to report on the 3 Ps concept. 3 Ps. So we have profits. Number 2, we have people. And then number 3, we have planet. So the people is what we are calling the social aspect. You look at the stakeholders, including your competitors. You also need to be good to them, because without your competition, without your competitors, you won't be doing as well as you're doing. You know, competitors push you. They make you, in this case here, wake up and smell the coffee and start doing best business practices. So you must also don't be that kind of a company that wants the competitors to die. Even if they die, you will also do what here, die then, if that is the case. All right. So then we have here that social. I've seen that question severally. The social indicators, social metrics, social metrics. I hope, ladies and gentlemen, with that little explanation, now it's clear. Are we together, ladies and gentlemen? Is it clear? Is it clear? Is it clear now? Is it clear? Is it clear somehow? And I can see we are 102. This 102 guys, if today they decide to subscribe to my channel, I mean, I'll be so happy, because I'm so sure most of them have not yet subscribed. If they say they're subscribing, I will be a very happy man. Hilda, 102. If they subscribe and then they share, very good. Very good. Ladies and gentlemen, I would, it's clear. Thank you very much, Sinta. Great, great. So then allow me. Yes, we are. Thank you very much. Great. So then come here. Come here. We go to the next question. You're almost finishing. You're on page number 16 out of 22. We should be able to finish. Remember, we have done 3 lessons. 3 lessons covering purely theory. It's important because most students that I know, they pass through theory. With regard to IPSAS 22, disclosure of financial information about the general government sector. Highlight 4 characteristics of a government, business, enterprise. Remember, GBEs, ladies and gentlemen, are the Kenyans. The Kenyans of this Kenya. I mean, they are government owned, or they were government owned. In this case here, government had shares, all right? And then at the end of the day, they get themselves like CASNEB. Like, you know, CASNEB is a GBE. It's a government-based enterprise. That is actually the very best. Why? Because CASNEB doesn't get funding from the government. CASNEB doesn't get funding from the exchequer. CASNEB is able to do its business objectives, pursue its business objectives. At the end of the day, they have students, they're charging fees. Actually, at the end of the year, they even give the government kind of what I would call dividends. So, in a government business enterprise, once the government, you have decided, or rather you have realized that this particular enterprise is doing, thank you, Nancy, thank you, Angela. Once you've realized that this enterprise is doing pretty well, please release it. How do you release it? Make it autonomous. The CEO, CFO, they should be able to sign, for example, checks. All right. So in this case here, it has to be autonomous. And then number 2, it should be a commercial enterprise. It should be like a profit kind of what here, making institution here, a profit making kind of institution like CASNEB. Now, ladies and gentlemen, here we are. We are saying here financial autonomy, GBEs, government-based enterprises, typically have a degree of financial autonomy, meaning they have the authority to generate their revenue, incur expenses, and manage their financial resources independently of the central government. This autonomy allows GBEs to operate in a manner similar to private sector entities, pursuing commercial objectives and financial sustainability. Then we have commercial activities. GBEs, ladies and gentlemen, engage in commercial activities that are intended to generate revenue and achieve financial returns. These activities may include providing goods or services to customers, operating in competitive markets, and earning profits or surpluses from their operations. Then we have ownership or control by government. GBEs are owned or controlled by the government, either wholly or partially. While the government may have ownership interest in GBEs, it does not necessarily involve day-to-day operational control because we have given them autonomy. Public policy objectives. While GBEs operate with commercial objectives, they may also have broader public policy objectives or social mandates assigned by the government. Financial reporting obligations, they must report on IPSAS, like most schools. Most schools we have outside, ladies and gentlemen, are government business enterprises. Because now, I mean, there are some of them in this case that are able to do what here? To post some profit, to post some surpluses. All right. Even if they're not posting any surprise, so long as they're able to generate their own revenues, they are able to incur expenses. They have what we call AIE, authority to incur expenditure. Maybe they have a board that approves. Then that becomes a GBE. At the end of each year, they have to prepare financial reports. They have to prepare financial reports. They must prepare financial reports. If you allow me, ladies and gentlemen, I'll not continue reading that. I'll go to a different question. Different question, different question. So we are here, of course, public accountability, public participation. The ISB framework for preparation and presentation of financial statements sets out the concepts that underlie development of accounting standards required. Discuss two challenges that might be encountered in the practical application of the above framework, whichever framework, be it the conceptual framework. All right. What are some of, in this case here, challenges are we going to have when we are applying this conceptual framework in coming up with a new IFRS? As I've repeated this severally, there are areas of this conceptual framework that would need judgment, your own individual judgment. So it means at times they are very what is subjective. They are not objective. You know, objective items are those items that you can give to two accountants and tell two accountants, read here, calculate figures, and then the two of them end up getting same answers. That will be objectivity. But if they end up getting different answers and they're able to substantiate, then it means that judgment and interpretation there will be quite diverse. The framework provides principle-based guidance, which requires judgment and interpretation in its application. Accountants and financial professionals may interpret the framework differently, leading to inconsistencies. Then, of course, this, you guys told me this, that this conceptual framework can, just like IFRSs, can be very complex and, of course, very subjective depending on the subject working on this. Then remember, ladies and gentlemen, the conceptual framework was produced what cases would call 19 Nyamioro. That is a German language. You can't understand that. Long time ago. Long time ago. All right. And yet, the accounting standards that you're producing today are supposed, in this case, to be for new businesses. And new businesses are evolving. So we have what we call evolution of business practices. The framework may struggle to keep pace with the evolving nature of business practices and transactions. Emerging business models, financial instruments, and industry specific practices may not be adequately addressed in the framework, leading to challenges in applying existing principles to new and innovative WTS scenarios. Lack of guidance in specific areas. We said, ladies and gentlemen, this conceptual framework is quite generic. It's quite general. It may lack, in this case here, proper guidance to us who would need to address specific issues in the new standards here. Consistency across jurisdictions. We have said, ladies and gentlemen, most of these countries have their own laws. So they'll be able to interpret this ISB quite differently. So in this case here, different laws, of course, will give us a problem there. Resource constraints. SMEs, especially or entities in developing countries, may lack the resources, expertise, or capacity to apply the framework effectively. Impact of, we should not read so many of them. Those are enough. Even technological issues here, because you want to do like a proper IFRS framework, can even apply it very well, but you don't have something that can handle the bitcoins like blockchain. Like we don't have very good many systems that can handle big data analytics. D, I'm doing very well because now I'm on page number 19 and I have 30 minutes to go. I'm so happy. So happy. Under certain circumstances, non-compliance with the detailed provisions of an accounting standard might be justified. Required. Highlight 4 disclosures that an entity that has elected not to comply with an accounting standard may make in order to explain the circumstances of the non-compliance. Ladies and gentlemen, this I'm able to answer very well. As I told you, even up to date, I'm the consultant of IGAD on matters to do with what here? IPSAS, International Public Sector Accounting Standards. So these guys, of course, given that they were adopting IPSAS for the very first time 3 years ago, they would not adopt all of them at the same time. And you're not, it's not, it's principle based. It's not like mandatory. There's nobody who's coming to tell you that you have some rope on your neck here that implement all of them. No, no. But ladies and gentlemen, if you have done your financial reports and you have applied some IFRSs or IPSAS statements here, IPSAS standards here, and left others out, then you have to do proper disclosure. Why you have not been able to use some standards in this case here from the entire set of these standards in this particular framework. You must be able, ladies and gentlemen, in this case here to tell us, hey, I have not been able to do this standard because of what. So you must give us, first of all, what have you not been able to comply with? Then you must tell us why have you not been able to comply with this. For example, just be very truthful. Remember, financial reporting is about truthfulness, faithful representation. Just tell us that we did not have in this case here the resources, the competence to be able to do this. But by next year, we shall be able to do what year? By next year, we shall be able to do. Now, from there, if you can, then you must give us the impact of you not complying. So, and if the impact is really very, very material, then we shall request your auditors to sit down with you and discuss on the better ways of you guys complying. All right. And of course, if you have not been able to comply, I mean, you must also tell us what have you done to try to mitigate, to try to reduce this impact here. So, ladies and gentlemen, if you allow me to share the screen back here. All right. Yeah, nature of non-compliance. Thank you very much, Tobias. Great. Great. All right. So you can see, ladies and gentlemen, here basically you are telling us the nature. Then you should disclose the specific account. Which standards have you not complied with? Why have you not complied with them? Could you be knowing the impact of your non-compliance in the financial statements? Could you be knowing? If you know, state. And of course, you must come here and tell us what you're doing to mitigate. If applicable, the entity should disclose any mitigating actions taken to address the consequence of non-compliance or to minimize its impact on the financial statements. Or even, for example, to ensure that, for example, in the subsequent year, what are we doing to mitigate? All right. So those 4, ladies and gentlemen, are really very good. Which standards have you not complied with? Why have you not complied with them? In this case here, what is the impact of the non-compliance on the financial statements? And what are you doing, you as an accountant? I mean, what kind of wheel are you rolling, ladies and gentlemen, to ensure that you do what here, you comply in the next season here? Right. And I can see we are 116, which is a great number. Most of you are not with us for block release. You need to join us. All right. If, for example, you do not have like videos that you should be studying with, you need to join us. So if you need any service from us regarding this revision, please, our number is 0793 555 000. 0793 555 000. That was a commercial break. Then you allow me to go to the next one. I'm doing very well. Now I'm on page 20 now. Doing very well. Doing very well. Now, with reference to IS 36, impairment of assets, discuss the treatment of impairment losses. Ladies and gentlemen, we have been able to discuss this concept of impairment losses severally. I don't know which language you shall be able to use, but there are things I would expect to see you capturing there. So, impairment loss, first of all, you must tell us the formula. Impairment loss is CAR minus RAR. It is carrying amount minus recoverable amount. Impairment loss, ladies and gentlemen, happens whenever the carrying amount is less. Whenever the, not less, whenever the carrying amount is more than what you are able to recover. If the recoverable amount is less than carrying amount, then the asset is impaired. And if the asset is impaired, of course, what shall you do? The impairment loss has to go to the income statement. And then you reduce the value of the asset by crediting that asset. Then go ahead and tell us, ladies and gentlemen, if it is a cash generating unit with many assets in between there, then this impairment loss has to be apportioned. But before you apportion, don't forget that, first of all, the biggest asset that will be able to be injured most when I'm distributing this impairment loss is goodwill. Goodwill. Once you start mentioning those kind of things like that, and then you come and mention something like to calculate recoverable amount. To calculate recoverable amount, what do I need? To calculate recoverable amount, what do I need? Is there somebody who knows how we can calculate this recoverable amount? Is there somebody who can tell us in this case how do we calculate this recoverable amount? We normally compare between two things. Recoverable amount equals, I will be able to say so many things. I'll be able to say so many things, ladies and gentlemen, here. I will be able to say so many things. And already I've given you a solution to this. I don't have to belabor. I don't have to belabor. Higher of value in use and net selling price or net realizable value. Realizable value. Great. So then allow me to continue, ladies and gentlemen, here. Allow me to continue, ladies and gentlemen, here. Allow me to continue, ladies and gentlemen, here. So this is what I have. Thank you so much. I can see you guys are great. Now I'm doing my last two questions. And then, ladies and gentlemen, we should be able to call it. I would want to give you like 10 minutes today. You eat your lunch, Now, IFRS 15 recognition from contracts with customers. This is a standard that so many of us, the examiner has used to knock us down. This standard, IFRS 15, and I would want to read it slowly. IFRS 15, recognition from contracts with customers. IFRS 15 is an accounting standard that outlines how revenue from contracts with customers should be recognized. It provides a comprehensive framework for companies to follow when determining the timing and amount of revenue to recognize from contracts with customers. Here is a summary. Scope. IFRS 15 applies to all contracts with customers except for leases, insurance contracts, financial instruments, and certain non-monetary exchanges between entities in the same line. Don't think about that. The thing is, we are looking at contracts with customers. Leave the exceptions. I cannot go to this exam without mastering the 5-step model of IFRS 15. The first step, the 5-step model of IFRS 15. From how do we recognize this, to the financial reporting and disclosures of the same. The 5-step model. So number one, we must be able to identify the contract with the customer. Do we have, first of all, a contract with this customer really? You could have just had something verbally, and then you tell me that, Malibu, I'm going to record this. No, there must be a contract existing with this customer. Then number two, you must identify the performance obligations in the contract. So for example, in the contract, this customer wants us to provide a computer and maintenance services. A computer costing this much and maintenance services which will be costing this much per year. Then we must identify what we call, what is it that we are required to perform ourselves? what is it that we are required to perform ourselves. So we must identify the performance obligations in the contract. Then number two, determine the transaction prices. So in this case here, these guys want computers, and so in this case here, what is our transaction price in full? And then how this transaction price will be apportioned, will be allocated to the performance obligations using some fair criteria. So allocate the transaction price to the performance what year obligations. Allocate the transaction price to the performance obligations like that. And then E, recognize revenue when or as the entity satisfies a performance obligation. So we have delivered a computer. Recognize that revenue. It was already allocated. We have done in this case here maintenance for first year. Now recognize first year's revenue. Recognize first year's revenue. So they're going ahead to define these things like what are performance obligations. These are promises to transfer goods or services to a customer and are the unit of account in IFRS 15. So what have we promised these customers here? The promises, which goods or services are we going to transfer to this customer? The company needs to identify each distinct performance obligation in a contract. Then the transaction price, this is the amount of consideration to which an entity expects to be entitled in exchange for transferring promised goods or services to a customer. So the amount, the consideration that you are paying, From there, number 5, allocation of transaction price. If a contract includes multiple performance obligations, the transaction price is allocated to each performance obligation based on its relative standalone selling price. Computer is 20,000, 20,000. Then now, recognition of revenue. Revenue is recognized when or as the entity satisfies a performance obligation by transferring control of a promised good or service to the customer. Control can be transferred over time or at a point in time. Then we have disclosure requirements. IFRS 15 requires extensive disclosures to provide users of financial statements with information about the nature, what do we expect, amount, and when, timing, and any uncertainties arising from these contracts. If there are any uncertainties, you must always come forth and tell, in this case, the whole world that there is a possibility we may not be able to collect this money from this customer, so that accountants can be able to foresee and provision. Vision is pro means seeing in advance. Provide provision. Provision. Provision, provide, provision. Very important. When you say that God is our provider, is able to foresee in advance that this ninja needs this number of students next semester. So it does provide provision. So you create a provision because now there are what year uncertainties. Because there are uncertainties. I need to be talking about this because there is a student yesterday who told me, Mwalimu, you can make a very good pastor. You can make a very good pastor. You can make a very good pastor. Now, ladies and gentlemen, is then IFRS 15 somehow understandable to you guys? Is IFRS 15 understandable somehow to you guys? Mhm, mhm. I can see guys are typing there. Unfortunately, there are ninjas who will never type anything. I don't know why. They're ninjas, I need to reward them. That I've taught them the whole semester. They have never written anything on Zoom, not on YouTube. Thanks, Wandera. All right. All right. Ruth Njogu, great. At least IFRS 15 now. It will not really somehow. Thanks, Mercy. Feni. Yes. Tobias Kebati. All right. Ladies and gentlemen, then the very last stuff. So basically, IFRS 15 aims to improve comparability, transparency, and the quality of financial information regarding revenue recognition across different industries and jurisdictions. Then we have this thing here that I'm really thinking, if I was an examiner, I would have brought this thing. SPPI test under IFRS 9. I would have brought this thing if I was an examiner. If we talk of SPPI, there will be very few people who can get this. If I was an examiner and I brought this kind of a question, I'm 100% sure that I will be able to knock away most of the students, in this case here, knock them out, throw them under the bus. bursaries and CASNEB going to CASNEB carrying graduates in this case here, you throw this guy out there because they'll not be able to answer. They will not be able to answer. They'll not be able to answer. SPPI test, SPPI, SPPI test. We did like a song around this SPPI test. Solely payments of principal and interest test. The SPPI test under IFRS 9, or the solely payments of principal and interest test, is a key criterion for determining whether a financial asset meets the classification requirements for measurement at amortized cost or at fair value through other comprehensive income. This test is particularly relevant for debt instruments. Debt instruments. That as a company, we have bought a bond. We've bought a bond. So this bond that we have bought, remember this time around, we have bought. We are the ones who have bought. So we are the ones in this case who will be earning what here? Interest. So ladies and gentlemen, please listen and listen to me very well. The moment you understand this, we don't have any business of being here. Solely payments of principal and interest, SPPI, principal, payments of principal and interest. Please listen, please listen. This is very, very easy. If, for example, I have this bond for an asset, and then I'm holding this bond till maturity, it's a 5-year bond, I'm holding it till maturity. So if I'm holding it till maturity, then I will be paid interests and my principal back. I'll be paid interest and my principal back to maturity. So meaning that this is a long-term asset that I have. It's not an asset that is held for sale. I'm going to keep it. I'm going to keep it. Just a moment, I see here. All right. If it will come, please blink twice as a sign. Oh, okay. We shall overcome. 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 So that asset, ladies and gentlemen, for a bond which I've bought, I've given away my money. And then once I've given away my money, I'm going to stay with this bond like forever till maturity. So then till maturity, what will I be paid? I will be paid my principal back and the interest thereon. So it meets the criteria of solely for payments of principal and interest. Principal and interest, it meets that. So that automatically means that it's a long-term asset. So if it's a long-term asset, ladies and gentlemen, whatever gains I get out of this shall always go to OCI. So it is either you do the amortization schedule, or whatever gains you get, you take them to OCI. You only amortize a long-term loan or a long-term asset. If an item does not meet this SPPI, then automatically, ladies and gentlemen, it is a fair value through P&L because it's a short-term asset. It's held like for sale. I have a bond here that I'm always looking at the secondary market, whether I'll be able to do what here, whether I'll be able to sell it, whether we shall be able to sell it. Let me read this for us to be able to understand here very well. Now, ladies and gentlemen, we are told here solely payments of principal and interest. The instrument's contractual terms must give rise to cash flows that are solely payments of principal and interest on the principal amount outstanding. This means that the instrument's cash flows should represent only the repayment of the principal amount borrowed and the compensation for the time value of money, which is interest. Principal amount, the instrument's contractual term should require the borrower to repay the principal amount borrowed either on maturity or through scheduled payments. I taught you yesterday how to do a loan amortization schedule whenever principal is paid, like say in 3 equal installments, etc. Number 3, interest. I don't have to read that. Assessment of SPPI. When assessing whether the cash flows meet the SPPI criterion, entities consider the contractual terms of the instrument. This includes evaluating whether the instrument contains any embedded derivatives, leave alone that. If SPPI is met, if the instrument meets the SPPI criterion, it qualifies for amortized cost or fair value through other comprehensive incomes. Fair value through OCI, because it's a long-term asset. Whenever a long-term asset is revalued, the revaluation gain or loss cannot be put in the P&L. It will go straight away to the OCI, Ladies and gentlemen, if SPPI is not met, if the instrument does not meet the SPPI criterion, it is classified as a short-term instrument and measured at what year? Fair value through profit or loss. Fair value through profit or loss. I would want to stop a little bit, ladies and gentlemen, and ask you, what have you understood about this SPPI thing? What would you mention here about if they brought an SPPI question, theory question, for 5 marks? What have you understood? What have you understood? Yeah, listen and listen carefully is a sign. What have you understood, ladies and gentlemen? What have you understood, ladies and gentlemen, here? What have you understood, ladies and gentlemen, here about this SPPI thing? About this SPPI thing? About this SPPI thing? About this SPPI thing? Cash flows? I like what I'm seeing Paul saying there. Verona float. There is nothing really to float there. I mean, this is a basic thing. It's even a high school thing. So I'm waiting in this case here to hear from you guys. This is a very basic thing. You'll be surprised. Very basic thing. Very basic thing. Ukichukua ni ngumu itakuwa ngumu, but it's a very basic things. Like now I can see what Agnes Gaba is saying. Bonds that are kept till maturity, the owner will be getting the principal and only interests. So the owner is not thinking of selling. You know, when you sell in between, it means you'll be enjoying the selling price, principal, and the interest. When you sell in between here, you know, if you are being paid like installments, then you'll have gotten some principal, you would have gotten, in this case here, some interest, and now you'll be getting some profit out of it. For this bond to be said to be an OCI bond, for it to be said to be an OCI bond, it must be a bond that earns you 2 revenue streams, 2 cash flows, the principal and the interest. But if you're a businessman who would want to do business with this thing, sell it and get a profit. Sell it and get a profit, then that becomes a short-term instrument. And if it's a short-term instrument, it goes through P&L. If it's a long-term instrument, it goes through what year? OCI. You can only amortize a long-term asset and not a short-term asset. Great. At least you guys are struggling to understand, you know. That's what I like. That's what I like. Yeah, fair value through OCI for the long-term assets. And the moment you mention some of those terms, even if you understand nothing, trust you me, you will be able to pass. You'll be able to pass. You'll be able to pass. All right. So, now, ladies and gentlemen, that is it. And of course, it has been a pleasure hosting you. I mean, I've never gotten this number of people on YouTube Live. This is good. It means this month YouTube should be able to give me a lot of money. I've never gotten this kind of number. I've never gotten this kind of what here, this kind of, I mean, like responses on YouTube. This is great. So please ensure that you subscribe. You subscribe. Number 2, advertise long-term. Great. Number 2, ensure that, ladies and gentlemen, I'm not teaching you alone. Now I'm also a high school teacher. And I only do high school home tuitions, these home or rather holiday tuitions, virtually, of course, virtually. And of course, I happen to be teaching now most of your brothers, sisters, sons, and daughters. So please also make inquiries regarding the same. We have very good classes that are going. Our number is 0793 555 000. Thank you so much. I'll be able to share the handout. I'll be able to share the handout in the paid groups because we want the students who are here also to pay us something. We are going to places you've never seen before. Thank you, Evelyn. Thank you so much. Be blessed, and then I will be able to sign off this as a ninja. Please remember, we are passing, all of us. Nobody's failing. I can assure you, like now, what I'm teaching here, there is no other college which has done this. Mimi najua sana. This is very exceptional. Like going through all the theories like that. Which college? At the moment now you have, like now the students who did this AFRA last semester, most of them were not able to answer these questions. But now I believe so strongly all the theories, you guys will be having an idea. You guys will be having an idea. You guys will be having an idea. So thank you very much for your support. We shall overcome. We shall overcome. We shall overcome. So see you later on for triple A. I'll be doing triple A. What time is appropriate for you for triple A? I think 10 p.m. is very good. 10 p.m. is very good because I realize daytime you guys don't have time. 10 p.m. RCM is the best college. I mean, best in 254. Best in 254. Thank you. Thank you. Principal is always paid with interest, yes. Principal is always paid with interest. Asante Vero, share handout, please. I'm sharing the group right away. I'm sharing in the group right away. Senior Ninja, thank you very much. Okay. So we signed off like senior ninjas like this. Bye. Bye. We are winning together. We need to win this together. Masim Wasaru, that's a very good statement. It's quite similar to we shall overcome. We shall overcome. And please preach the gospel of RCM at your workplaces. Tell them this is the place. This is the place. Thank you and bye.